Mike. How are you?
Doing good, doing good. So Glenda's joining me today because I was actually going to do this by myself because I got some things I want to talk about. And so I'm doing this whole, mini podcast thing and figured I'd give some insight, some opinions. This is the kind of stuff I talk to people all day, all the time about. And I figured I should share it with, whomever. So what we're going to talk about today, just right out of the chute, so you kind of know what you're getting into, is I read an article the other day or I shouldn't say it was an article, it was more of a news story from NBC talking about how DFW was the least affordable place in Texas to live. We're going to talk about how bad inflation is right now and kind of where it's getting and what it's doing to interest rates. And I'm going to talk about the Dallas-Fort Worth housing market and the housing market as a whole and kind of where the future is going for that and what you should expect and what you need to start looking for. And is now the best time to buy a home? Okay. So I would probably venture to guess, Glenda, you would agree that these are probably, especially when it comes to should I buy a home right now, probably one of the most asked questions we get all the time.
That is probably 99% of the time. That's the very first question I ask mine is of what your payment is. Is it a good time to make that home purchase?
And I talked to 3 people myself today, and that was exactly, what our conversation was. So anyway, like I said, was going to do this alone, but I'm glad to have a friend with me. So at least I can bounce something off of him. So it doesn't sound like I'm just talking to myself the whole time, but I spend a lot of time reading about this stuff. I'm kind of a nerd when it comes to these things. I have a lot of conversations about this, but it's like, what are we supposed to do with social media? We're supposed to talk about, dump our brain onto the planet and see where it gets us. So the first thing is I saw a news report the other day from NBC that was talking about how DFW is the least affordable place to live in Texas, which was kind of surprising to me because I kind of figured, I thought it would be like Austin.
I would have figured it would have been Austin first.
Yeah, that would have been what I thought, but not so much. So so right now, and the way they kind of measured this stuff is, and let me put up kind of the order in which they go on these things for the rankings. I even got pictures. I have all kinds of fun stuff.
I am so proud of you. So yeah, I'm kind of jacked into Mike's today. He was going to do it alone. I was like, hey, I'm already here in the office. So if you want someone else. So it's all about Mike today.
That's right. That's right. So, so I'm going to show this a couple little pictures here, but so this is one of the images that we got, which basically
Tyler.
Can you see that, Glenda? Is that showing up on the thing here?
That is crazy. Dallas.
So yeah, Dallas-Fort Worth, number 1. Number 2 was Austin, which, I mean, we kind of know that Austin's got, expensive home prices.
Georgetown and all of that area surrounding.
Right. Yeah. And then, hang on, let me move that over here. There we go. This is the one. That's how it should look, right? There we go. So Dallas-Fort Worth, number 1, Austin, number 2. Home prices have been crazy there. Everybody's moving there. Yeah. Tyler was the one that was a little surprising.
Well, I think if you think about Port Arthur, Beaumont, and then I'm surprised, above Houston.
Port Arthur, Beaumont, and Houston, I oil and gas, like I get that.
But Tyler, Longview, it is. And my entire in-laws live there. And my sister-in-law is Smith County Treasurer, and she can see it. So it's just because they want to move out to a rural area.
Gotcha.
And Tyler is not rural anymore. It's super crazy, but Longview, it all kind of blends now, like DFW does. So.
Okay, so it's kind of just because you're pushing out in that direction. Yeah. It's becoming more of a metropolitan.
It
type
is
area.
For sure. Like Tyler is busier than DFW sometimes. I feel like when we go down there.
So those are the areas that are the top 5 in the state, and it factors in things like which I have this up here in just a second. I'm trying to navigate between switching screens and doing this. It factors in things like cost of living, obviously the home prices, rent. It also factors in utilities. So, for example, with groceries and whatnot, but utilities, we pay the highest rates in the country here in Texas for utilities.
What?
I'm sorry. The 3rd highest rate. Sorry.
That is crazy to think that in Dallas-Fort Worth.
Yes. I mean, we are oil and gas or near about, but because we have Houston and other parts of the state that participate in that, but we also drive a lot. You know what I mean? So
we drive a lot because we don't have mass transit.
Right. There's no mass transit here. So you're driving all over the place. Healthcare is also factored into this, groceries, just general transportation. The transportation stuff, because we don't have mass transit, everybody has a car. We all pay for gas, and that's kind of where we are now. In Texas too, we are 10% higher than the national average for utilities specifically. So we're in the top end of that and paying a lot for it. We are 6th worst in the country for lack of affordable housing in Texas.
Oh, I can see that. And I think we talked about that last week when they're building so many condominiums and apartments right now, because there's really no, I mean, there's nowhere to go. The
No.
supply and demand here in DFW. And I know we had talked about this, a while back, is there's 300 people a day moving into DFW.
Yes.
And so that's just going to make everything widespread. And there's not enough raw land. I mean, people think that, oh, Texas is really big. Well, yeah, it takes 8 hours to get to every side, but it's in housing. Oh my gosh, with taxes too. We were talking about that earlier. Oh my gosh.
It's pretty insane. Yeah. Especially with the way property taxes have been jumping up as well. But yes. And then, so they had another statistic on and it's on NBC's website. You can go to it. It was a story that they ran. They said that in order to afford a 2-bedroom apartment, that you need to make $22.50 an hour to be able to afford a 2-bedroom apartment right now.
And when's the last time you talked to a first-time home buyer that makes $22 an hour?
They don't.
Right.
They don't. So the long story short of this is that it is getting extremely expensive to own a house anywhere in the country. And especially right now, because of the demand that has, really pushed our direction from all the people moving into the state. Now we're in a world where it's incredibly expensive all the time.
Right.
And so like, if you look at this little chart that we have here, a little map of the country, you can see that all the places in red, okay, back. It's got little details on there. So this is affordable housing and available rental homes per 100 extremely low income renters. So basically they're taking like the extremes on this, but they're essentially saying that for every 100 people that are extremely low income, there are less than 30 houses or 30 places for them to live. Okay. That's how they measure this. And we're similar to California, Nevada, Arizona, Colorado, Florida, and Oregon. So essentially the affordability that we are existing in right now is little to none,
right?
Because it's extremely expensive to live here, especially in Texas with all these costs that have come up.
Right.
And, it's not, this isn't something that I'm highlighting because I'm trying to freak anybody out or, make anybody worried that they can't afford to live. But this goes back to what we always talk about, how, when it comes to buying or selling homes or owning your own home, right? If you own a home, you might be paying a lot for it. You might be paying high rates. You may be paying high prices, whatever the case may be, but you still have the ability to build equity and grow wealth in that situation.
Absolutely.
And if you're renting an apartment or you're renting a house or anything of that nature, then the opportunity for that is obviously much less. So, and especially when you're, I think a lot of people in the country and in Texas specifically, a lot of people live paycheck to paycheck, right? Yeah. It's like they don't have a ton of money in savings. I can't remember the exact statistic, but there was something like, 40% of households in the country, if they had a $10,000 unexpected expense, they couldn't afford to meet it because they don't have that money in savings. So, this just kind of highlights the fact that everything is getting more expensive.
Right.
Now, we do hope, obviously, that this is going to come down at some point.
Right.
But, it's like anything else. Whenever you can get someone to pay $100, or I think the airline industry is a good example. If I can get you to pay $50 to check your bag, and I say, well, our costs are going up. This is just what it is. Hopefully this won't be permanent. Am I ever not going to get $50 from you to check your bag?
And it's always going to be permanent. They're not going to take it back.
Right.
They like their profits.
That's right. Or like the toll road, right? I'm going to drive down the toll road. Now, what we're going to do with the toll road is we're going to charge you for the first 5 years.
Right.
And then after the road's paid for itself, then the toll will go away.
No,
the toll does not go away. You keep paying.
The hashtag 35, because that place is never going to go away. No. But it brings up a good question is how do you try to survive and buy a house in this market?
Right.
With it going up and $22 an hour is not going to happen. A lot of my clients, personally first-time home buyers, they're now buying with brothers and sisters, and they're going back to really of kind of where it started, and they're getting a co-borrower, and they're getting a roommate, but their roommate together to buy a home is better than paying double in rent. That literally rents are being like wiped out in front of them.
Yeah. Well, rents have gone up, and I think I have something on this in a second. Rents have gone up like 25% just in the last 12 months in Texas.
Yeah. And the highest increase in the last month and a half.
Yeah.
Because renters and landlords, they're having to increase taxes as well. And they feel that they can get it. And so they're literally just increasing them for no reason. Because they want to make more money.
So then everybody asks, okay, so then why is everything so expensive? All right. Well, obviously we've been in a situation for the past, really it's been the last 12 years where once we had the crash in 2008 and 2009, where everything fell down, the monetary policy changed in the United States. And we said, okay, in order to make sure that this doesn't continue to happen, we need to put money into the market. So this is where the Fed stepped in, lowered rates, started buying mortgage-backed securities, which we've talked about before is what drives mortgage rates. And this purchasing or this lowering of rates and then purchasing of mortgage-backed securities put basically made lending not free, but pretty close. So you could borrow money for next to nothing.
Right.
And whenever money's cheap, then what you start to see is assets that tend to hold their value and tend to give you some sort of rate of return. The value starts to go up, which is why you saw the stock market shoot up, which is why you saw the housing market shoot up, because now borrowing the money and not having to come out of pocket a ton of money in cash has afforded me the ability to buy an asset that is going to continue up and appreciate. So people that, I don't want to say are smart with their money, but people that know what to do with money when it's available tend to invest in assets. That's where they put their money, because I need to put my money somewhere that it's going to grow. I don't want to put my money in a place. I'm not necessarily going out and buying new Jordans and putting it on the credit card. What I'm doing is I'm buying a rental property, or I'm investing in index funds, or I'm putting my money that I was able to get from somewhere. Or, we have this conversation all the time with people buying homes. When you're going to put, you're buying your primary residence. And I tell people all the time to either put down the minimum or put down 20%. Right. Well, when you put down the minimum at 5%, you're going to pay mortgage insurance. Your mortgage payment's going to be a little bit more expensive. But the $40 or $50 or $60,000 that you would have had to put in if you put down 20%, you can now use to make money for you.
Absolutely.
Right. You can make that money work, because the only way that you make money is you trade your time for money. Right. And that's having a job we do every day, giving our time, sweat equity. You have a business, which is still to some extent trading time for money, because you got to build that business up at least till it can run itself, or you use your money to make money. Right. So investing in real estate is one way to use your money to make money, because if not your primary residence necessarily, but investment properties, VRBOs, those kind of things, those are going to generate rent. So that is an income generating property, which makes you money. Investing in the stock market, when you put your money into index funds or you buy specific stocks or whatever, those now that's fluctuating. It's a little bit of, these days, everybody who wants to day trade, I'm like, you can do what you want to do, but good luck. But safe things like index funds that tend to earn a 4 to 6% appreciation or return on your investment on an annual basis. And then you compound that over 10 or 15 years, for sure, then you're going to make money. Right. So then when the money was cheap, then everybody who could borrow and had the ability to borrow would then borrow and then put money into places that would make money. Right. That's what happened. I'll do a little side crypto deal, but this is what happened with cryptocurrencies. One of the reasons that Bitcoin fell off as hard as it did, because at one point, one Bitcoin was worth $70,000. That's crazy. Okay. Today, right now, it's worth $20,000, give or take. It's floating between 18 and 20. But 24 months ago, it was like $5,000, right? Yeah. So you could say, well, it fell off tremendously. Well, what happened is individuals like us, not me, because I didn't do this, and I have Bitcoin. But individuals like that were buying Bitcoin, retail investors, which are who individuals are, they would buy, say, $10,000 worth of Bitcoin. Okay. Well, then Bitcoin would go from 5,000 to 10,000, within a week or two. Right. And now they only put in 10 grand, but now their $10,000 investment was worth 20. Okay. So then what they could do is they could then leverage and go, well, I'm going to borrow 10,000 back from my Bitcoin and I'm going to buy more. Right. And they just kept repeating that over and over. And as the price went up, everybody was leveraging, because the interest was like 1%, 2%. It was nothing.
Cheap money.
Exactly. So then that leverage, when the moment things ticked in the other direction and things started selling off, that's when you saw it crash, because all of those people that were leveraged into that market had margin calls every time that price would drop. Right. So then they would have to sell. They didn't have a choice, because you either sell it or you come up with 10 or 15 grand, which they didn't have.
And you didn't have that money because you spent it.
Because you spent it. So because it was all leveraged or debt, leverage is the fancy word for debt. Everybody's like, oh, I'm using leverage on this. Yeah, you're taking out debt.
Your debt.
That's what you're doing. But because they were over leveraged, then that caused, it was like a domino effect. Everything just came down, right? And then it hit a point where it settled in. But this is what was occurring. This was happening with real estate too. Right. The reason that prices shot up the way they did was because over the last 2 years, there have been private equity companies and hedge funds buying up properties
30%.
In mass. Yes.
30%.
Correct. In Texas, there was 30%. They were buying these properties in mass and then turning them into rentals, because right now we're in a place where you rent your car, you have a lease, right?
Right.
A lot of people have leases. Do you own any like audio cassettes or CDs anymore, Glenda? No. What do you do?
Rent them.
You pay Spotify, right? Or you pay Apple,
and pay Disney Plus.
Yes, exactly.
So, and you rent a Peloton. Like that's
rent
what's funny. Like you rent your Peloton.
You even rent your phone. You think you don't rent your phone, but you do
for sure.
Because your phone's $400.
Yeah.
And they're like, well, you can just pay it out.
$1,200. Thanks, Apple.
Right. You can just pay it out over the next 24 months. Well, then after 24 months, your phone's obsolete. So now you got to get another one.
And now you're getting another one. So now there's a lease to rent and buy up program.
That's right. So we don't own anything anymore.
We don't have anything of tangible value because it's all obsolete the next day.
So the thing that's left is housing, right?
Mm-hmm.
We have a ton of renters already. The rentals have jumped up dramatically. And it's getting heavier and heavier as we go.
Right.
But that is kind of where things are headed. Now you can believe that's intentional or not intentional or whatever.
I know my conspiracy on it.
Yes, I got lots of conspiracies on that stuff. But at the end of the day, that's where it's going.
Yeah.
And when you have private equity companies buying up entire neighborhoods in like Houston, 500 homes that D.R. Horton built, and Blackstone goes in and buys them up, and then they turn them all into rentals. Okay.
Right. That does not help our inventory.
You drive down the road. I saw, and here in Mansfield, there's like these little houses that all look exactly the same. There's probably 50 of them, maybe. I don't know. I haven't gone in there. And it says luxury homes for lease. So you can't buy it. And they don't share walls. They have all these like no shared walls, no blah, blah, blah.
Yeah.
But you can't buy it.
Yeah.
You're leasing it.
And you never had the option to buy it because
Never
the
was a
builder
choice.
went straight to
That's
the
correct.
corporation to buy it.
Never had a choice.
So the builders, and it all kind of stems back to the builders pushing their stuff. Right. Last year, we were laughing. One of the agents this morning posted, where were you like 2 years ago?
Yep.
Because it was 2 years ago and a year ago. And it's crazy. We think about that. The builders were like, shoo, fly. They went around the realtors to get that commission. And now they're like, hey, here's your $20,000 if you come to my front.
Yep.
Well, why, and it was a perfect depiction of why builders 2 years ago and a year ago did that. And they sold them to BlackRock and all of these. And now they're like, they're trying to get people back in there. And they're like, agents, come on, I'm starving. Here's your $30,000 off price, whatever.
Yeah. They're giving extra incentives on the house, which is great for agents and buyers because they're finally balancing it out. But
it's going to turn around though.
We'll get to that in a second. It's going to flip around soon anyway. But so let's talk about the inflation side of things. All right. So last week they came out with the CPI, which is the consumer index or consumer price index. And it showed overall that inflation was up by 8.2%. Okay. Right. This was a little bit higher than what was expected. Everybody always thinks that they know what the numbers are ultimately going to be. So, but it was a little bit higher than what was originally anticipated. Right. So that caused the markets to kind of freak out a little bit. Now,
did they freak out? Whew.
Yes. Now, when you take out, there is something with inflation where they take out they call it core inflation. So they pull out food prices and energy prices, or gas, basically.
Right.
I should say, actually, it is gas and food. I say energy. There's difference when it's electricity. It's factored into utility, so they don't take that.
Right.
And that was at 6.6%. Mm-hmm. Now, the reason they take out food and gas is because it's very volatile because it moves up and down. Like for instance, with gas, long term, you can control to some extent when you produce it, and you have oil rigs in your state and your country, and you can make your own gas, and that's a whole other conversation for another thing.
Yeah.
But right now, OPEC controls the flow of gas for the most part.
Yep, for sure.
So if they want to raise up the production and lower the price, they will. And if they want to lower the production and raise the price, they absolutely will.
And what happens in 3 weeks from today?
Right. And their margins are like 90%, is what they make. So these guys are making billions of dollars producing this oil. And so, but we don't have any control over what they do. Yep. Now, there are geopolitics and stuff that can do that, but I'm not getting into that. That's just, for the most part, there's no control. So that's why they pulled out. Same thing with food. We don't have control over how food flows, and it has nothing to do with inflation because it could do with the climate. It can do with how crops turn over. It could do with the access, the war in Ukraine and Russia. There's less access to fertilizers and nitrogens that feed the soil because there's a lot of that gets produced.
The wheat product that Russia actually produces for the United States. Yes. And my favorite word, like Mike and I will talk about, is supply chain COVID oil.
Yeah.
Like they're still stuck in a boat, which is crazy. You think 2 years ago, but they're still backlogged from sitting in the boat. And they even said this morning, like retailers, they're already worried about the holiday buying season because they still have summer inventory that they're having to work on And that all is included in the inflation numbers. Like, what's the retail, right? You already have to think about December and January at this point, and retailers are having a big issue right now.
Well, and now you have with the retailers, what's going on with specifically with like goods, and I don't want to say goods services, but just goods in general, like your televisions and your shoes and these kind of things. They're actually they're getting oversupplied because they put up these heavy orders that came in when everything was back ordered. Well, now all those orders are in, and now they have a ton of inventory that they're sitting on.
And people can't afford them.
Right. Nobody wants to go buy anything.
No one wants to buy them. What, 75 days before Christmas?
Because they're terrified that they're gonna lose their job or something, right?
Right.
So here's some of it'll be harder for you to see these over there, but so some of these inflation numbers. This was just a tweet I pulled off Twitter. So your overall CPI was 8.2, your core CPI was 6.6, gas was plus 18.2%.
That's insane.
It's massive.
That is crazy. When it went up to $5 and then the next day it's like, oh, by the way, we have stock again, supply and demand, and it dropped to $3. But the day OPEC said they're cutting production, what happened?
Shot up.
It shot up again.
And then you have fuel oil, okay, which again is still oil and gas, is 58% higher. Electricity was 15% higher.
That's crazy.
And this is month over month. Or actually, this is average for the year. I'm sorry. Groceries were plus 13%.
Yep.
Okay. Meat, poultry, and fish. Why they categorize those separately?
Eggs, 30%. I think that's like 60% for eggs.
That's why I got chickens.
Get chickens.
That's
there you
right.
Go to USDA.
Milk was 15%. Baby food was 11% higher. Can you imagine your baby? You have a new baby and you're living paycheck to paycheck, and your bill just went up 10%.
Yeah, and it's crazy. Like even that 80 cents is now at like $1.89 now. Like that baby food, that's horrible.
It's a lot. Airline fares, 42%.
Yeah, and those aren't coming down, people. If you think they're coming down to give you a holiday deal, you better look at that.
And by the way, the airlines are still making a ton of money.
They're making a ton of money.
They're killing it. Their profit margins are massive. And it's the last one was real average or hourly earnings. Okay, that's down 3%. Okay, so people say wages are going up, which is true.
Right.
But when you compare how wages have gone up compared to how inflation has increased, it's the other direction. It's going down. So your dollar is going less further because even though you got a 50% raise, it's not enough to cover the 10% gas price.
And it's like, what do you do? And now it's going to go back to what you have to cut out, right? You have to cut out the goods. And so now Starbucks is giving, you're going to cut out the commodities that you can't afford or the ones that you can easily get rid of, right? We like coffee. I know I don't drink coffee, but Starbucks has already given discounts on that stuff. You see even like Chick-fil-A starting to, like every supply chain is starting to offer like 20% off, 30% off discount. And it always cracks me up about like the Black Friday sales. Like I am a avid Black Friday. I love to do it, but I go to People Watch. I don't buy stuff because I go 2 weeks before to see the prices. And then I go the day of Black Friday. And believe it or not, it's more expensive on Black Friday.
Yeah.
It's the thought and the promotion of it's the day you're supposed to shop.
Right.
Well, when it comes down to it, Black Friday is actually the most expensive holiday. You just don't look at it 2 weeks before. So there's a fun fact for Black Friday.
Well, and everybody wants to know is like, when is this going to turn around?
Oh gosh, we all do.
This is just my opinion, right? Of course. But the Fed raising rates is affecting the money supply and making money more expensive, therefore causing people to borrow less. But when you look at what we just showed you with the things that are actually driving inflation, the vast majority of it is still food and gas.
Right.
Okay. Airline industry is more expensive because they have to pay more for gas.
Right.
Your electricity is more expensive because they have to pay more for energy. So these are all tied to things that, again, my opinion,
we can't control.
We can't control
the milk prices unless you go get a cow.
So it's like we're living in this world where they're raising rates to make goods and services, less and less demand. So it brings down the price.
Right.
But, until the war in Ukraine ends, then food's going to be expensive. And until OPEC decides that they want to produce more oil and gas is going to be expensive. So I don't know where jacking up rates is going to adjust this, but they're still doing it. And again, we have no control over that either.
No.
So the Fed does plan to continue to raise rates, but I do think, and thanks to Barry Habib and MBS Highway, which is one of the things I watch all the time, they have these great little charts that they like to show about inflation and when it's going to peak. So this is something I pulled from them. When you look at September, okay, by the way, we're in October. So when we got the numbers for last Thursday, those were September's numbers.
Correct.
Right. So when you look at September, Well, September is at 0.03. So that July, August, September inflation was very low.
Right.
Okay. For the month over month. But when you get to October, now it almost doubles.
It spikes.
Okay.
Yeah.
So when we look over here at where we're at today, and by the way, if anybody that's watching this doesn't understand, the way the CPI works is it's a 12-month rolling average.
Absolutely.
So it would be from the number that we just got was from October of last year to September of this year.
Right.
So that's 12 months. So the number that we get in November will be November of last year to October of this year.
Right.
All right.
Right.
Well, so every month a number rolls off.
Right.
All right. So when we did it this last Thursday, the number that rolled off was that 0.3.
Right.
Which was why it was higher, because the number we got was 0.6.
Absolutely.
So that's going to make the 12-month average more.
Yep.
Right. Well, come October, that number jumps up. Well, the expectation is, as much as they've jacked up rates and people are starting to hold back, prices in certain areas are going to start to come down.
Right.
So the expectation is, or the thought is that the October number is going to be less than what it was for last October.
Right.
So the overall CPI should tick down.
It should.
In October.
Yeah.
It should. We'll see. Nobody knows.
November 2nd. Put that on your date.
Right.
We'll be going live.
Right. But if that happens, then, because right now the Fed's mandate is that they have to get inflation under control. Like that's their whole mandate.
That's their narrative right
now. That's
For
all they're focused on. So they're going to keep raising rates until they start getting indications that the market is turning around.
Right.
All right. Well, we've already seen, we had those huge swings in the market last week. We were up, I think the Dow on Thursday swung. I had this in here too. It swung 1,500 points.
It was crazy.
In one day.
It was insane.
Okay. It was the sixth largest move in one day for the last decade.
Yeah.
Okay. And that it went down and then it came right back up.
Right.
So even investors don't know what the hell's going on. They're like, we're just trying to, a lot of this is on emotion. They're trying to figure it out.
But emotion.
But if inflation does tick down, then you should start to see the Fed pivot and say, okay, we're either going to raise rates less or we're going to pause. And oh, by the way, the other thing that I think a lot of people miss on this is that this is like, you don't really feel the impact of this stuff for like 12 months.
Right.
Right. So we're just like 3 or 4 months into when they started raising rates, and we're not really going to see that adjustment until later on, but that's a whole other thing. So hopefully the idea is that, next October or next month, when we get these new numbers, that we should see a tick down, which means maybe the Fed will pivot a little bit, which means maybe mortgage-backed securities will do a little bit better. So we should start to see some lights at the end of the tunnel. Okay. But so what does that mean for the housing market in general? All right. Well, just so everybody understands, housing in the United States is 25% of our GDP, which means that not just buying and selling houses, but, home improvement, Home Depot, Lowe's, electricity, all the things that are tied to somebody owning their home makes up 25% of our total GDP as a country.
And their stocks are down right now.
Right. So, Fannie Mae, now I'm going to give you the bad news first, and then I'm going to tell you the good news.
Yes.
So Fannie Mae put out their projection, and they feel like in 2023 that home sales will decline by 18%. Yeah. Okay, that means we're going to keep going down. I think this year we're already down like 10 to 12%.
For sure.
And that's about 5.6 million units. And then in September, this is up from what they projected last month, which they thought it'd be 17. So they just keep bringing that number higher, where they think it's going to go down. But oh, by the way, so demand, they say, is going to go down 18%, but they still only predict home price values are only going to go down by maybe 1.5.
And that's crazy. So there's the big automatic, because the factor is, that's the conversation we have. And that's the narrative that the government, I think, is trying to put on there. And here we go. We got Jen Gaudio up in here. What do you think the narrative talking about that the home price is not coming down as much as people think they will, right? So the Fed fund rate is continuing to go up, but home prices are not. Jen Gaudio is
She's
not.
backing up slowly.
She's backing up, but we have what about a DTI? We can ask about a DTI. And it's not going to change, right? It's the demand is still there.
Right.
The 300 people moving into Dallas every day, there's not enough housing, is not going to drop.
No.
The price of the homes, right?
Well, they're not building houses. The thing is, and we're actually going to get a number later this week, housing starts, which it kind of indicates where things are, the direction that things are headed. And what a housing start is that basically is like a builder is going out applying for a permit to build a house on a piece of property.
Right.
Okay. Sometimes they'll do entire neighborhoods. Sometimes they'll do one. So they're applying for that to build the home. Well, overall, housing starts have been ticking up. Now they're starting to plateau a little bit, but they have ticked up.
Right.
But what you don't see is when you dig into that number, the things that are going up are multifamilies, apartments, duplexes, townhomes, condos. Those are ticking up. What is not ticking up is single family residences. That's the house on the land that everybody wants, right? They're not building more of those. They're telling us basically that you're going to live in an apartment. So, or a condo, and you're going to pay $300
assisted living.
HOA dues.
So many, sorry, y'all, assisted living and over 55 communities are like head over heels, because you have to think about it. The baby boomers aren't selling their homes because of COVID.
Right.
COVID was a big indicator that they're just scared. They don't want to go into assisted living or an over 55 community. But that is like one of the number one communities they're building right now. I know, especially in Midlothian, it's huge. They built 6 of them within a 5-mile square radius, and they're already booked out. But the boomers, but the millennials, there's still 45 million millennials that need to get into a home eventually.
Well, hopefully when the boomers retire, there'll be some inventory opened up, but they're not all retired. They're not all, well, they can't.
They can't because they can't afford milk.
No, they can't. So, and then also too, Black Knight, which is a large, they're a reporting agency, but they do a lot of reporting for like hedge funds. There's Black Knight, Blackstone, there's all
not the griddle, not Blackstone.
So, they put out a statistic that homeowners in forbearance, so people that had applied for forbearance, that 46% of them were making their payments in April. So in other words, they applied for forbearance, so they didn't have to make their payment, but they were still, 46% of those people were still making their payments. Okay. Right. But then in May, that number fell down to 22%. And then in June, that number fell down to 15%.
Right.
So now let me be clear. It doesn't mean that they're delinquent. What it means is that they applied for forbearance, they got it,
right,
and they had the option to either continue to pay their mortgage or not.
Right.
Okay.
Right.
So 3 months ago, 50% of those people were still paying their mortgage, whether or not they needed to or didn't. But that number is declining quickly because people are getting a little insecure, right? And they're keeping cash. They're going, well, I don't know what's going to happen. I need to have my cash, right? All right. So that's all the bad news, right?
Yeah.
But here's the thing. When you look at actual foreclosure data, so this is something, there's a Texas A&M, they do a monthly report where they put out all the housing data for the state of Texas, and they give it by market areas. And I go to them a lot to see kind of, what they're saying about stuff. So if you look at the last month's payment status for owner occupied housing. Now, by the way, this was through August. Okay. So it's a little bit behind, because data takes a minute to come in. So when you look at, if you look at this chart, it said, the first chart says last month payment status for owner occupied homes. So households currently caught up on their mortgage payments. Owned free and clear, we'll just talk about Texas. 38% of people in Texas own their home free and clear.
That's crazy.
57% of people are currently caught up on their mortgage. Only 4% are not.
4%.
4%.
That's great. So here's a crazy, I was talking to an agent yesterday or Friday, and one of her clients is about to go into foreclosure. They said, okay, let's do a really short sell, where they didn't technically have to short sell it, but they listed the home.
Yeah.
Well, instead of doing the foreclosure that was going on auction today, they got $18,000. They did a super quick close, got it under contract, did that. Well, those people don't have, and that's the thing. Like, instead of foreclosing on your home, sell your home. You're walking away with $18,000. Instead of getting the foreclosure on there, they would have never even had 18,000.
Right.
Goes back to not having 10,000 in your bank account.
That's right.
And she was so happy that she didn't think about a quick cash option.
Yep.
And there's, investors out there that will buy this to help them.
It's all about price. You lower the price enough, they'll get it.
For sure.
Then the second one says likelihood of having to leave this house in the next 2 months due to foreclosure. So the first one was how many people are currently caught up on their payments. Okay. And then the next one is more of like, do you feel like you're getting into trouble?
Okay.
Like you're getting close. So again, in Texas, likelihood of leaving this home due to foreclosure, 8% is very likely. Okay. It's a very low number. 12% is somewhat likely. 49% is not very likely, and 29% is not likely at all. So that's 80% of the people that are either not likely or very unlikely to have any issues making their payment in the next 12 months.
That's amazing.
So all the talk of foreclosures are on the horizon. Just wait.
Yeah.
It ain't coming, man.
It's not.
They have too much equity. People have picked up 30 to 40% equity in their home for the past 2 years. The story that you just told is exactly indicates why that's important, because that person still had equity. They got behind on their payments because their monthly payment was difficult to make.
Because taxes, and then he lost his job.
Right. But if you just lower the price and sell the house, you're
For
still
sure.
making money.
And they can live on, $18,000 for months for now.
Yes.
Right?
Yes.
And
So
it's just crazy.
it's I'm just trying to highlight the fact that, this
Options.
idea that there's going to be this massive foreclosure. Now, don't get me wrong. If the economy takes a huge dive and we have massive layoffs, anything can happen.
For sure.
Okay. But so far, the job market's been pretty good. It's not, struggling too bad. So, I don't know that that's happening either anytime in the near future. But so right now, we only have 2.5 months of supply on hand in Dallas-Fort Worth. So the supply on hand means the number of houses that are available based on the rate at which they sell. Yep. So if I have 250 houses available for sale, okay, and I sell 100 a month, then I have 2.5 months of supply.
Right.
Okay. Well, in a healthy market, you need to have anywhere between 5 to 6 months of supply. That's what you have to have. Okay. Yep. Well, we're still at 2.5. Are we 8 months into this? 6 months?
6 months into this kind of crazy market.
Craziness. And we still have barely enough houses. Now, again, that number's going up.
Right.
Okay. But it's going up very slowly. It's not just turning over, immediately overnight. And by the way, on that number, this is another thing that gets left out. I had an agent ask me about this the other day. That number includes houses for sale, land for sale with a house that isn't built. So
land. There it is.
Well, what I mean, I don't mean raw land. I mean land by a builder. So I'm a builder and I own 50 plots in a neighborhood. Those 50 plots are for sale. They're going to be homes, but they're not yet. So they're actually not really able to purchase. So I can't buy it or sell my house until that's done.
Yep.
And so and there's a good chunk of those that are being represented in that number, and it's still,
especially in Ellis
really
County.
Low. Right. So you're not getting a whole ton of houses for sale. You're not seeing a whole bunch of stuff coming down the market for foreclosures. Well, let's look at the prices. Okay. Well, maybe the prices will come down and that'll save us all because the prices are going to be really low.
Right.
Again, here we are. So the median home price, and we'll just do Dallas-Fort Worth. Okay. In July of 2022 was $406,000. Yep. In August of 2022, it went down to $404,000. So
it's not a big jump.
No. Interest rates in that same period of time went up 200%.
Right.
Okay. So interest rates have massively jumped up and prices have only gone down just a little bit.
That takes a while. And when you think about when it's supposed to hit the floor, I mean, you're talking about years before it hits the floor. And
even if it does.
Right.
Right. Because it's just slowly ticking down. And it's understandable. And I'm sure if September's number will be a little bit less.
Right.
Right. Because people are a little concerned the demand has gone down because we don't know if we're going to be able to have a job or what rates are going to be and all that kind of stuff. But again, prices are not falling off a cliff either. Okay. They're going down, but they're not going down at a dramatic pace. Yeah. Okay. So, and the big thing that I want to make sure people understand is that we are slowly we talked about this a second ago, we're slowly turning into a nation of renters. Okay. Mm-hmm. Right now, 43.7 million households are currently renting.
That's crazy.
Right? We have 300 million people in the United States. Yeah. The number of households is something like, I think it's like 120 million or something like that. It's about half that number. Right. And almost half of those people are renting. And by the way, that number was like 20% or 30% like 3 years ago.
Right.
So it's gone up dramatically. Entire zip codes are turning around. So the thing that I'm trying to impart is that we are in a very different market than we were 12 months ago. And we just had this conversation with a bunch of agents this morning. And what we have to do is help people understand that you have to change your mindset as to what you're looking at. And 8 months ago, if you were buying a house, or 12 months ago, if you were buying a house, you were buying a $350,000 house, you were paying $400,000 for that house.
Absolutely.
And that extra $50,000 that you were paying over, you were bringing cash because the house wasn't going to appraise for that because the market had not cut up.
Absolutely not.
Well, why was I paying $50,000 over? Well, that's because there were 30 other people in line to buy that house.
Because you wanted to pay it.
Well, you didn't have a choice,
You didn't have a choice. If you wanted that house, you were paying it.
But good news, rates were 3%, 2%. Yeah. Yay. Okay. Congratulations. Rates were cheap, but they were cheap for everybody.
You got the stress of sitting in line and waiting and getting an appraisal and paying hundreds of $1,000s.
And Glenda, what if you had an FHA or a VA or a USDA loan? Were you buying a house?
You were not
12
buying
months
a
ago?
house.
You were not.
Well, not even 8 months
Why
ago.
not? Why were you not buying a house?
Well, because a conventional cash is king.
That's right.
Your cash, most of our, and not all of them, when we say most, right? Most of first time home buyers, they don't have 30,000 liquid cash. But even our VA buyers, it's a misconception on a VA buyer to have hundreds of $1,000s of cash.
They don't.
Well, VA buyers are honestly some of the most qualified to buy a home.
But it's hard because, like we said, people are living paycheck to paycheck.
Yeah,
they don't have $100,000 saved up unless mom or dad are giving
unless
it to
if
them.
they sold a home recently and they're turning and burning that money.
Yes,
and that's where a lot of it came from.
Exactly. And as we get more renters in the market and less people that own their homes, the less equity is going to be available to those people to be able to get out of renting into buying.
For sure.
So fast forward to now, right? Then you were 3% interest rate. You were paying 50 grand over and coming out of pocket a ton of money. So now here we are 8 months later, we're in October, rates are 7%.
Yeah.
And oh, by the way, not only rate 7%, but you're paying 1 point in order to get that 7%. Now it could be 6.875. I don't want to say, well, our rates are at 6.5. Okay, well, great. You're probably got 2 discount points worked in there. But what I'm saying is on average, they're in the high 6s, low 7s, depending on your scenario. And you were paying 1 discount point to get it. Used to, if you wanted to pay a point, it meant you got a lower rate.
Right.
Now it just means that's the cost of doing business and you're paying it. Well, why is that happening? Well, another video, another time, but essentially when you have a volatile market and rates are going up or going down at a quick pace, there's always the option for refinancing. And whenever that happens, even when rates are going up, they could go down soon. So whenever you have the option to refinance, that makes investors nervous because they want to service the loan and make money on the interest. That's how they get paid.
Right.
But if you only have the interest for 12 months and then you refinance it and somebody else gets that interest, then as an investor, I don't have that money coming in. Right. So I'm not going to pay as much for that loan and I'm going to charge you up front. So I make sure I make my money.
So the investors want to get make money.
Investors want to make money. So that's what they're going to do. So when you have 7% interest and you have all these charges and fees that are going along with it that are extra, well, then what does that do? That puts a lot of buyers on the sideline. Yeah. Okay. Which is completely understandable.
Absolutely.
The problem with that is that this, again, I've said this before. I'm a lender. Glenda's a lender. We do mortgages. We love loans. We want you to do a loan. We want you to buy a house. Okay. That's what we want. All right. We're not going to pretend like that's not the case. Nope. However, right now is still probably a really, really good time to buy. Probably better than it was then. Okay. Right. And hear me out. The reason why is because now if I'm buying a $350,000 house, I'm paying $350,000 for that house.
If not lower.
Or I'm also saying, hey, look, seller, I'll pay you $350,000. Yeah. But I want you to give me $15,000 in closing costs. Okay. So now, or I could offer $335,000, right? Mm-hmm. But it's the same to the seller. They're getting, if their house is listed at $350,000 and you offer $335,000, they get $335,000. If their house is listed at $350,000 and you offer $350,000 with $15,000 in seller concessions, they're still getting $335,000. Right. Okay. And sellers that are thinking about selling or need to sell, put it that way. If you need to sell, you have just come off of 2 years of 20% appreciation over and over. Okay.
30 or 40 or 50.
Right. So you've probably made unrealized because you don't have that cash in your pocket, but you have made a lot of money on your house if you sell it. Okay. So if you need to move and you need to sell it quickly, you may have to come off your profit a little bit and take a little $10,000 or $15,000 hit to help somebody get into the house that doesn't have all that cash saved up. Because again, those guys don't. And the heaviest buyers right now are what, Glenda? Who are the people?
First-time home buyers.
Correct.
They're government.
Those loans? Yes.
USDA, FHA, and VA.
Because they couldn't get a house 12 months ago. Now they can because there's nobody buying homes, or less people, I should say. Yeah. And so now they have a chance, right? But they also need money. So if you want to get your house sold and you want to sell it quickly, you're probably going to have to offer up a little bit in order to make that happen. Yeah. Maybe not. Maybe you have a perfect house. You price it right. It's in a high demand neighborhood. Great. Good for you. But if not, if it's sitting there, or if you've had to reduce the price a couple times, look, put in your listing, agents, put in your listing that you're going to offer $10,000 to $15,000 or whatever the number is in seller concessions.
Absolutely.
Because if I'm a first-time home buyer, or I'm just a buyer in general, and maybe I don't even have an agent yet, I'm on Zillow or I'm on Redfin and I'm looking at properties. Well, if you're listing in your listing description, you put in there that there's $10,000 in cash for me, I'm going to go look at your house.
That first time home buyer is like, ooh, I can stay there. I can like it.
That's right.
I don't have to love it, but I can like it.
Yeah.
Because I can sell it later on and get the return of investment.
That's right.
And grow it.
That's right. And now I have a higher rate. Okay. So that's not ideal, but all my closing costs are paid because the seller's paying for them for me. And I have a higher payment for a period of time.
Right.
Okay. And I've said this before, but interest is a function of time. It's not a function of money. Yeah. Okay. When you pay interest on something, if you're paying 30% interest If you're only paying 30% interest for 1 month, it's not a lot of money.
Right.
Okay. If you're paying 2% interest for 30 years, that's a lot of money.
That's a lot of money.
Okay. So if you're only paying 7% for a year or two, that's not a whole lot of money,
Right.
especially if rates come down, even to get into the 5s or the 4s or wherever they may end up landing again. When those rates come back down, you will have the ability to refinance.
And you're already going to be in your house.
Right.
Because the next tick and the next wave of the buyers that didn't want that,
Well, that's what I was going to ask you. When the rates go back down, what's going to happen, Glenda?
It's going to be a crap storm. It's
Yes.
going to be exactly a year ago.
Yes.
And then first time home buyers are going to be discouraged because they didn't jump on it quick enough. And
That's
it's
right.
not like we would ever push anybody to doing a loan. No. But what we're saying is if you can financially manage $100, $150, $200 more a month and get a co-borrower and get someone to move into
and not have to come out of pocket 50 grand,
not have to come out of pocket and have sellers pay for those,
yes,
then why not look at it?
Right.
Because that is the narrative that's not being spoken right now.
Yes.
It is rates are high. Oh my gosh, that payment's $200 higher. But what if you didn't have to come up with an extra $15,000?
Yes.
Well, guess what? We can refinance you.
That's right.
That's what we're good at. We can refinance.
But if you wait because you're scared of the market, and again, the whole point is you have to find out information. Yeah. That's all we're doing is providing information. Then you get to make the decision. Absolutely. If it makes sense for you and your family.
Yeah.
We're not making the decision for you.
We're not making the payment.
We're just telling you, we're just having you look at it from a different perspective and understand, I said this earlier, Warren Buffett, one of the richest people on the planet, his general theme is buy when people are selling and sell when people are buying, because you get value when you're doing something that nobody else is doing. So if nobody else is buying homes right now, that means you're going to, or not as very many people, that means you're going to get a good deal.
Yeah.
Okay. But there's a reason you're getting a good deal.
Right.
Because rates are high and everybody's terrified.
Yeah.
Okay. But while they're scared and you're making smart decisions.
Great. It's such a great time.
And property values go up in 12 to 24 months, which they will again. All this stuff turns over. It's all cyclical. Then you're going to be in a great spot, and you can also refinance. And the beauty about refinancing is you get to take all of the money that it costs you to refinance and just add it to your loan.
Yeah.
You don't even have to pay.
So that's your no cost refinance that lenders are already talking about. And one of the agents in our classes this morning had it. I mean, she nailed it. She said, ride the dip.
Yeah.
Buy
the dip.
Buy the dip. That means when it's down, buy the dip. When the rates are up, you buy the dip. Like you're going into it before the dip and the wave comes, because when the wave comes back, it's going to be another 30, 60, 100 offers. You're going to need cash. You're going to need reserves. So why not? If you can afford it right now, get in when the dip is here.
Yep. So that's all I really had today. I just, I'm hoping I'll maybe do this next Monday again. Just take in some data from the week, fill it in my brain,
I won't be here next Monday,
and then give you my opinion on it. But that's what it is. I mean, look, it's expensive right now. Inflation is killing everybody. The housing market is struggling because of this, but there are benefits and there are ways to take advantage of it and still continue to add to your wealth, grow your wealth, develop a portfolio for yourself while everybody else is on the sidelines scared, clutching their purses. Because I'm not saying it's the right move for you. I'm just saying you need to look at it and get all the information and then be able to decide if it's something you need to do.
And buyers, we see you, right? It's not that we have these conversations because we've bought homes before.
Yeah.
We've been in your position. When I bought my first house, it was 6.75.
Yeah.
I looked at it the other day and I was like, oh, dang.
Yeah.
Now I
think it's what we pay, like
$130,000. But guess what? My taxes were $5,000 when I bought the house, and I was like, "Dang, no wonder I moved out of where I did, undisclosed location." But it was still 6.75.
Yeah.
Well, what are we in right now?
Yeah. Well, and then the last house that you bought, you got like a 3 or 4% rate, right? Like it's just, again, interest is a function of time.
Yeah.
It's not
and it will come. So we see you, we get you, and we're here for you.
That's right. All right. That's it. Wrapping it up. It was a little longer than I was trying to get 30 minutes, but I rumble on forever. So
sorry.
All righty. Well, we'll see you guys next week. We'll be back at this again. And if y'all ever have any questions or want to talk through scenarios, give Glenda or I a call. That's what we're here for. There's no cost. There's no charge. It's just, hey, where are you at? What are you trying to do? Here's some options. Here's some ways to look at it. And then ultimately make your own decision.
Yep.
All right. See you guys.